Welcome back, guys, to another Zero DTE video, and today Ernie's going to be talking about minimizing drawdowns, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy, guys.
The probabilities tell me that over the course of a year, I'll have about somewhere between 350 and 450 trades. Let's say 400 trades. Now, I also know what my win rate is. My win rate is approximately 50%. Currently, it's at 47.6%, but let's just use 50% as the good standard. Now, I know that when you're trading 50% in any account, you can take the log 2 of a number and it will tell you from a statistical point of view, what are the highest level of streaks, winners and losers that you can expect. It's a statistical determination. And by doing that, in a 400 trades or so over the course of a year, that number comes out to somewhere between 8 and 10. So let's say it's 9 or 10. Let's just say it's 10. So that means that there's a pretty good probability that over the course of a year, trading 400 times, that there is going to be instances where I have a streak of 10. Now that streak could be a winning streak or a losing streak. It doesn't matter. But let's say it's a losing streak. So can I handle 10 losers in a row? How big do I have to make my position size so that I can handle 10 losers in a row? That is how I figure out what my position size is. Now, there's another way I go about it. I look at standards that are tried and true in the industry. And one of those standards is for drawdowns for professional traders. And I've always heard this and confirmed it with many, and it's the number that I always used to use, and it's for very good reason, that most traders use 10% drawdown as their gold standard. You don't ever want to go beyond a 10%, but a 10% is manageable to get back to your previous high point. Anything beyond that starts becoming increasingly more difficult to get back to your high. In fact, it increases at almost an exponential rate. If you draw down to 50%, it will require you to gain 100% to get back to where you were. If you're at 10% drawdown, it's about 12% that you have to get back to where you are. And there's a point between 12 and 20 where you start going over what I call the event horizon. It's like going over the event horizon heading towards a black hole. There's a point of no return where the ability to come back starts becoming exponentially more difficult. And so that's why traders choose this 10% level, because it's a level that is well before that event horizon and allows you to easily get back. Let's say I have a $100,000 account and I know that 10% of 100,000 is my maximum possible drawdown that I can ever tolerate if I want to abide by this gold standard. So that means that 10% of 100,000 is 10,000. That means I cannot lose more than 10,000, all right? Worst case scenario. Now, going back to my log equation determining what I can expect in terms of streaks, I know that I can get a streak of losers of about 10. That's a likely scenario that could happen. All right, so if I know what my max loss can be, 10,000, and I know the number of positions or number of consecutive trades I could have that could bring me to that max, which is 10, then all I have to do is take that 10 and divide it into 10,000, and it will tell me what my max position size could be, all right? That number comes out to 1,000 for a $100,000 account. To use as a rule of thumb, it comes out to about 1%. Now, do I trade 1% every time I enter the market? No way. I always want to leave myself room. So I usually start at a third to a half of my max position size, so that if I want to, I can add to the trade. Either I have to put on a completely new trade because that trade became invalidated, or I can add to that trade if it pulls back and it's still a good trade by all accounts. Then I can get a better cost basis. But what I can never do is increase my total position size more than that 1%, right? So that's how I figure out my max position size. Now, that 10% rule was really meant for substantial accounts, six-figure, high five-figure, or six-figure accounts, or seven-figure accounts. Once you start getting higher, that 10% rule starts getting a little wonky, and you need to reduce it even a little bit more, maybe to 9 or 8%. It's within the range of what most people trade. Even professional traders mostly are trading between $100,000 and $1 million. And that 10% rule works well. And so you can come up with a reasonable approximation of what your maximum position size should be, your outer limit, in order to always stay well under that 10% drawdown. In my case, I try to keep it under 6 or 7%. Once I get to 4 or 5%, I start taking mitigating strategy into play so that it will slow my descent if I start going on that descent, and try to manage it as best I can. That's how I control drawdowns. I start with that 1% maximum position size. I hardly ever trade it. I usually start with a third to a half. And then if I get into a bad beat and I start drawing down, once I get to 4 or 5%, I start employing mitigating strategies. And that means basically reducing my position size even more. And I keep reducing it until it's so small that there's no way that I could possibly achieve that unless I have just this monumental streak of bad luck. That is my methodology for keeping my drawdown in check.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.